Good evening, everyone. Thank you so much for joining me today. My name is Stewart. I am the founder and lead financial coach of Do Better Financial, and welcome to our Me Economy Monday live video. I have a couple of announcements to make before we get into our topic for today. The first of them being, I would like to wish all of the many October babies a happy birthday. I like to call them the New Year's babies because October is 10 months after the New Year, so these are our New Year's babies. I have a list of people. I will be very sad if I miss you. Hi Kendrick, thanks for joining us today. I'll be very sad if I miss you, so I'm gonna read off a few names. Please don't be offended if I leave your name off. These are the ones that I came up with off the top of my head. Hi, Sister Gloria. Thanks for joining us today. And if you have somebody you want to wish a happy birthday to, whose birthday is this month, hi, Phyllis. Thanks for joining us today. You can list them in the comments as well. So I'm going to start off with our most recent birthdays. Hi, Chris. Thanks for joining us today. And that would be my pastor, Pastor Vernon Hubbard, and his wife, Sherry. They both celebrated their birthdays this past week. Want to wish a happy birthday to them, as well as Sister Cheryl. She got surprised with a pretty awesome Snoopy themed birthday party. They knocked her socks off over there, so happy birthday to her as well. Sister Ola Franklin, if you watched last week when I was on with Deborah, you heard her wishing her mama a happy birthday. Hi Brittany, thanks for joining us today, as well as my best friend Whitney, my dad, my nephew Chris, who I wished a happy birthday a couple weeks ago. My cousin Mason, Hi, Destiny. Thanks for joining us today. As well as Miss Elizabeth, who is a member of our praise team. She is out with her family, living it up. And so I just want to wish a happy birthday to all those people. Again, if you have people that you love whose birthdays were in October, please give them a shout out in the comments. And if I see them pop up, I'll say them out loud. Second piece of housekeeping. I found out yesterday that early voting started today for a special election going on in Harris County. So if you're in Harris County, registered in Harris County, excuse me guys, I'm about to start coughing again, so give me a second. All right, let's try that. So early voting is starting as of today, and it goes through November 3rd, which is Friday, and it's from 7 a.m. to 7 p.m. It's a special election for a few different constitutional amendments. And again, if you vote early, you can vote at any location, so just look it up on, I think it's harrisvotes.com or .org. This is pretty annoying. Sorry about that. It's Harris Votes. You can look up your ballot and what exactly is on your particular ballot. What I saw was a lot of constitutional amendments. Some of them look pretty interesting. Things like allowing survivors to maintain their Homestead Act exemption for their taxes. A couple of other things that look pretty interesting that I probably need to dig into some more. When I get some more information, probably over today or tomorrow, I'll let you know. But yeah, take time to participate in your local elections. They are just as important, if not more important, to your everyday life because they affect your everyday life. That's how they decide to put up red light cameras and, make laws about texting while driving and things like that. So vote if you don't like those, or even if you do. So today's video is actually going to be about health insurance. Now earlier I posted a question asking what people thought was the #1 cause of bankruptcy in America. Now a couple of the options were things like overspending, and another one was job loss, and I think the last option was divorce or separation as in a marriage. But the #1 cause of bankruptcy, which might come as a shock to some and not a shock to a lot of others, is medical bills. People, about over 60% of the people who declare bankruptcy in America are doing so on their medical bills. Now, FYI, because I'm sure people are thinking, it's not student loans. You cannot bankrupt student loans. Otherwise, I'm sure that would be #1. But since you can't bankrupt those, the #1 answer is medical bills. About 60% of people who declare bankruptcy in America are doing so because of medical bills. And here's something that's probably a little bit sobering. 70% of those people who do file had some sort of health insurance. Usually when you hear about somebody filing bankruptcy while they have health insurance on their medical bills, they're underinsured or they had a plan that they didn't understand. So what we're going to do today is go through, obviously we've established that you do need health insurance because while 60% of people who do file bankruptcy are filing, and 70% of them had health insurance, I can guarantee you will go bankrupt real quick on something like a couple-day hospital stay if you don't have health insurance, right? So let's go through a couple of definitions. First one is the word deductible. And basically, it's just the amount that you pay before the insurance kicks in. So you might have a really low deductible, you could have no deductible, or you could have a very high deductible. Now, all of the plans that I'm going to discuss today have, you're going to hear that word. Some of them have no, some have low, and some have very high. In general, the lower your deductible, the more expensive the premium, and that's in very large, like sweeping generalization, but the premium is the amount that you pay per month out of your pocket, right? But yeah, the lower the deductible, so the less that you have to pay before the insurance kicks in, typically the higher the premium, right? And so the higher the deductible, the lower the monthly premium. Okay, well, the second word I want to define right quick is max out of pocket or out of pocket maximum. Now, what this word means is that this is the most that you'll have to pay in a planned year. So for instance, if it's 2017 and your out of pocket maximum is $9,000, I'm making up numbers, don't assume that any of this matters. If it's $9,000 and you go get an MRI, before you went to get the MRI, you were at $8,700. The MRI cost you $350. Well, you pay that $300, and then the insurance covers $50, and for the rest of the year, they'll cover 100% of the remainder of your costs. That's usually how out-of-pocket maximums work. Of course, as with everything, read your fine print. Some people find ways around this, okay? So what are our options when it comes to insurance? So the first one, there's going to be a lot of definitions and 3-letter acronyms in here. Please don't glaze over on me. This stuff is important, okay? So the first few you've heard. We're going to start with HMOs and PPOs. So HMOs, I didn't know what this meant, and you probably don't either. It's a health maintenance organization. And typically what they do is they're going to require you to see a primary care physician or a PCP before you can get a referral to see any specialist. So for example, I'll use myself. I have lots of knee issues. I frequently need to go to the orthopedist, which is someone who specializes in joints. If I had an HMO, I would need to go to my, runny nose, I've got the flu, I've got sinus infection doctor to get a referral to then go see my orthopedic doctor. That's usually how HMOs work. There's a lot of restrictions on them. They usually will not cover you if you go out of their network. So that means, say for instance, you have a plan that doesn't cover Kelsey-Seybold, but Kelsey-Seybold's next door to your house. If you go to Kelsey, they will pay for nothing. You have to pay for everything out of pocket, right? But if you go in network, they're going to cover quite a bit. Usually the premiums are pretty low and the deductibles are pretty low. So there's one of those things that I talked about. It was a generalization. This one's unique because of the amount of restrictions they place on you. You might ask, why is that the only information you're going to give us about this plan? Because they vary so widely. But we're going to talk about if you need help figuring out your own personal plans in a minute. So the next one is a PPO, and that's your preferred provider organization. So it's similar to an HMO, but it's a little more flexible. You still have that primary care physician, but if you go out of network, you will have some coverage, just not as much. You get better treatment as far as pay goes within your network. You're going to have a higher premium than the HMO, and usually you're going to have some deductible. Oh, awesome. Sister Paulette Mooten's birthday is today, as well as Kamashay Thomas and Tony DeWalt. Happy birthday to you guys. So you're going to have more flexibility with a PPO, but you have to, you're going to pay a little bit more, and you may have a deductible. Now, you may say, well, why wouldn't I just go with an HMO? If you don't have access to the specialists that you need in network, that is going to be the biggest reason not to choose an HMO, because they won't cover anything. So if you have some sort of illness that you need taken care of by a specific doctor and they're not in your network, you would either have to pay for them out of pocket or find another type of insurance. So the last one, which is becoming really popular, is the HDHP, high deductible health plan. And those are just what they sound like. You have a higher deductible, so you have a lower premium. Now, the great thing about high deductible health plans is usually they don't really have much of a network, right? That's good because that means you can go see who you want. It's also not so good because frequently that means that if you that they're not going to give you as much discounts on the people who are in network if they have one. Now, when I say high deductible, some of those other plans might have a deductible of $200 or $300, maybe $500. HDHP's by law minimum deductible for an individual is $1,300, and the deductible for families is $2,600. Yes, that's a lot of money. But if you're a person who is sick a lot or rarely sick, the lower premium cost up front may make sense. So let me explain the one if you're sick a lot. So if you're sick quite a bit, if you're always at the doctor, if you're constantly getting something like allergy shots, or if you're always getting cortisone injections, if you have regular maintenance for something like diabetes or high blood pressure, it might make sense, especially if you have an emergency fund, to go with a high deductible plan. And here's why. Once you reach that limit, like I said, once you hit, if you're an individual, once you hit that $1,300, your insurance pays for absolutely everything. So if you're a person who's spending $400 or $500 a month on your insurance, you're gonna hit that pretty quick. Especially if if you spend extra money on medications, because that's included in this. Also, if you're a person who rarely gets sick, you can pay a very little amount. And when you do need to go to the doctor, again, you're probably going to need to have an emergency fund. But when you go to the doctor, you pay for it. And if you do have an emergency, car accident, a serious illness, injury of some sort, then, you come up with that $1,300 or $2,600, and then they're going to pay the rest. So one of the things that is really a great feature of high deductible health plans is something called the HSA. Health savings account. It's called the health savings account. So the great thing about it is that it is tax deferred, pre-tax savings. So you would actually be able to save directly from your paycheck into a savings account without paying tax on that money. And then you would be able to use it for qualified expenses. If you go to the government's website, you can get a list of what the qualified expenses are for an HSA. But like I said, if you went to the doctor and you needed to get an MRI, an X-ray, if you need to buy glasses, frequently if you need to get some dental work done, now you gotta look at your own health plan to make sure. But a lot of times, like dental work, if you need to buy crutches, that's what I have too, Chris. If you need to buy crutches, things like that, it does not cover over-the-counter medicine unless it's prescribed to you. That was a change that they made, I don't know, maybe 5-6 years back. Won't lie, made me sad. But it's still a good opportunity. Thanks, Mommy. My mom's wishing me a happy birthday, but I'm not in October, baby. I'm November. But yeah, y'all won't see me on my birthday. I'm just going to let y'all know that right now. Deuces, because it's home Monday. But the HSAs are a really awesome opportunity. If you work at a company that also contributes, that money is tax-free for you as well. So my company is one of those. They contribute some money, I contribute some money, and I use it when I need to. It's a great option. You can also get one of these if you are self-employed. The next option that I'm going to discuss, which is the FSA, the flexible savings account, you can only have, hi Lucretia, thanks for joining us today, you can only get through an employer funded plan. So the HSA, another great thing about it is if you're self-employed, you can actually purchase this on the open market for yourself. So the FSA, which is the flexible spending account, and HSAs are you can only have them with an HDHP. You can only have them with a high deductible plan. FSAs, you can have with any of the rest of these, only if it's through your job, right? So it's similar, it's pre-tax, and you can use the funds for those pre-qualified expenses. The only difference is that for an HSA, your funds will roll over to year. So if I didn't spend all my money last year, it's still here, and if I don't spend it all here this year, it's still there when I get to next year, and it can be applied to my deductible. For the FSA, it may or may not roll over. You may have a grace period. Right. Yeah, my mom has an FSA. You may have a grace period of like 2 months after the year's closed. So they may say, okay, you got till February or March 15th to spend your money. Here's what I'm going to tell you. don't let that money leave. If your company is giving you money on your FSA, or if you're investing your own money in your FSA, spend that money, okay? So if you get to the end of December and you're like, man, we still have $500, go get your teeth cleaned. If you got wisdom teeth to pull, go do it. If you need to get glasses, go get glasses. If you already got glasses, go get sunglasses. Spend that money, right? This is basically tax-free money, and if you don't spend it, it goes away, right? So make sure you utilize your money. So those are the general plans. There are some other options that are available. We're going to start with the catastrophic health plan. So this is like a high deductible plan on steroids. It's only available to people under 30 or who get what's called a hardship exemption. And when I say hardship, I mean financial hardship exemption. It's very low premium, extremely high deductible. Oh, yep, go get your teeth done, Lucretia. Hi, Grace Joe. Thanks for joining us today. Very, very high deductible, and it's a bare bones plan. I think you get 3 or 4 primary care visits in a year, so this is strictly preventative care. If you get a cold or something, you're paying for it. But it's a good opportunity to not have to pay the penalty under the Affordable Care Act and to have some, like they said, catastrophic. This is insurance for I broke my leg, I need to have my appendix removed, we had a terrible car accident, God forbid, but that's the kind of insurance that this is. Now, if you were to get laid off or you were to lower your hours on your job, you are eligible for something called COBRA. You've probably heard the name. I'm going to tell you what the acronym stands for. You won't need it later, but that's my thing. So it's the Consolidated Omnibus Budget Reconciliation Act. Say that 10 times fast. Basically what it does is it's a law that gives you, the employee, the opportunity to maintain your group health care coverage if you go below 40 hours at your job and they don't supply health insurance, or if you leave your job, right? Now, the great thing is that if you love your health care insurance, you can maintain it. The deal is you now have to pay 100% of the premium. Most people don't realize just how much their companies typically pay for their insurance. You would now have to cover your portion and the company's portion. That can get very pricey, but it's better than being without health insurance. So if you get, if you find yourself unemployed rather swiftly, it's a good option for the short term for sure. If you have the money, my mom said for the FSA, you can spend it all early in the year before you actually paid into it. So that's an interesting thought. So you can do it the opposite way instead of waiting till the very end. So COBRA is a good option if you lose your job swiftly. If it's very expensive or if it doesn't fit your needs once you leave, because some of the plans are not identical, they'll have a little bit of a difference. You definitely want to find that out if you're leaving your job and you don't have insurance lined up. Another good option that will allow you to avoid that tax penalty is the medical cost sharing program. Now, there are quite a few of these. A lot of them are faith-based. But they typically work like an HMO, not an HMO, they typically work like a higher deductible health plan. You're going to pay a small monthly fee, just like a premium, right? They described it as a gym membership on the website that I was using. You're going to have incident cost. That's what they're called, which is like a copay, all right? But because a lot of them are faith-based, they don't cover things like abortions and birth controls. Now, that's not all of them. You have to really read into it. Make sure that these are going to fit your needs. They are lower cost, but the things that they provide are going to be a little bit different, okay? Last but not least, the government-provided health cares, Medicare, Medicaid, and CHIP. Medicaid and CHIP are available to people who are on Social Security or eligible for Social Security, and children in varying amounts by state. So you'd have to check with your state to see if you're eligible and what that coverage is going to look like. They're not all the same. Medicare is the government-provided health insurance for people who are 65 years of age or older, people who have disabilities, or who have renal failure, right? People who are on dialysis. They're going to have an HMO or PPO plan. So if you're looking at one of those, hey, Renika, thanks for joining us today. If you're looking at getting Medicare in the coming years, you're going to want to see which one of those is going to fit best. Remember, the HMO is going to have very limited options, but lower premiums and probably no deductible. And the PPO is going to have a little bit higher premium, probably a little bit of a deductible, but you're going to have a little bit more flexibility and the ability to go out of network for specialists. So bear with me, there are 4 parts to Medicare, okay? I'm going to do them out of order. Don't freak out. So Part A is hospital, which is just what it sounds like. It covers hospital stays. Part B is medical insurance as we know it. So that would be going to the doctor on a regular basis, getting your prescription, your primary care physician, all of that. Part D, yes, I skipped C, is prescription drugs. So this is to help to aid in the cost that particularly the elderly and the sick have with their drugs. Those things get very expensive very quickly. So Medicare Part D assists you in your prescription drug costs. Now here's why I skipped C. C is like a platinum version of all these rolled into one, right? So Part C, which is the Advantage Plus program. Hi Cameron, thanks for joining us today. Is going to have the hospital and the medical insurance, and a lot of times it will include prescription coverage, but you need to check to be sure, right? These are sold by the regular insurance companies like Aetna or Blue Cross Blue Shield. I think I even saw one by AARP, right? It's sold by those people, so they're not all the same. They don't all cost the same. They don't all provide the same things. So if I'm going to give you this, I'm going to throw my daddy into the fray. My daddy's a pharmacist. He understands more about a lot of these than I do. But if you have questions, I will gladly glean from his understanding to help you the best that I can. ACA open enrollment starts November 1st, so not tomorrow, but the day after. It starts on Wednesday. Hopefully today the Astros will be the World Series champions. Yay! Hi, Sister Regina. Thanks for joining us today. So that's from November 1st through December 25th. That's ACA open enrollment, which is open market. And then Medicare general enrollment is from January 1st through March 31st, okay? So the reason that I'm actually doing this right now is because we just got through doing open enrollment at my job. A lot of companies do open enrollment in the month of October, November timeframe. Through some point in December-ish, and the same is true for the open markets. There's one caveat for Medicare. So Medicare, you're going to apply for your insurance January 1st through March 31st. It wouldn't take effect until July 1st, okay? So you want to keep that in mind. The qualifying events for typical on-the-job insurance are usually, if you don't get in during open enrollment, it's going to be marriage, divorce, childbirth, adoption, and death. That's the other one. Hi, Justin. Thanks for joining us today. Those are your qualifying events. For Medicare, your qualifying event is turning 65. So you have 3 months before you turn 65 to apply, all the way through 3 months after you turn 65. If you miss that window, you have to wait until January 1st to apply. So if you've missed your window, if your window is coming up soon, January 1st through March 31st is your time frame. So if you need help sorting through any of these, please let me know. Don't go without health insurance. There are some options out there to at least get you catastrophic health insurance so that if you have something huge happen, it doesn't bankrupt you. Like I said, a lot of the people that you're looking at that are bankrupt here are dealing with chronic illnesses, and also they're just flat out underinsured. If you need help trying to figure out if you can work it into your budget, which plan's going to be right for you, sorting through the Medicare stuff, I would be happy to help you and to enlist my father to assist you as well with the expertise that I don't personally have. If you have any questions, if you need some help, ready to get this stuff going, you can email me at christian@dobetterfinancial.com. Or you can send me a request on our website, dobetterfinancial.com, or you can look me up on Facebook or Instagram, same thing, @dobetterfinancial. So, last week I was not here. I was a guest on Conversations with Deborah Franklin. Shout out to Deborah. We were discussing holiday spending and the options for gift giving and exactly how we're going to celebrate this year. So, today I want to make a little announcement. As you all know, today is the 30th. Tomorrow will be Halloween. You may not have realized how quickly the year has passed. So, let me give you a little perspective. In 3 weeks, it will be Thanksgiving. Hi, Naisha. Thanks for joining us today. In 6 weeks, the beginning of Hanukkah will start. In 8 weeks, Christmas and Kwanzaa will be here. And in 9 weeks, New Year's 2018 will arrive. Yeah, it's here. the holiday season is officially upon us, and whether you celebrate any of the holidays I listed or not, there's a good chance you're going to be participating in festivities of some sort, whether it's family gatherings, company parties, watch the ball drop parties, and you're probably going to be giving out some gifts, whether that's white elephant or buying gifts for kids, or even buying gifts for people who don't have anything this year, right? There's something that we used to do at my old church. It was called Angel Tree. It was pretty awesome. You would buy gifts for the kids of inmates whose parents were in jail, because and you'd write that it was from their parents. And I mean, it's just a nice gesture. But either way, this time of year, Americans spend literally millions of dollars, and then they experience what something like financial distress that comes after excessive expenditures and spending, and I call that the holiday hangover. Okay, you know how at the end of the year we've put up the lights, we've taken down the lights, we've bought the turkey, stuffed the turkey, we've eaten the turkey, we've gone through buying all these gifts. Now we're returning the gifts because people bought us stuff we didn't want or that didn't fit, and you throw all the boxes away and you enjoy football or basketball or whatever sport or nice thing you guys like to watch on TV. It's a Wonderful Life. And then comes January and the bills start to roll in. And all you can think is, oh man, why did I do that? Why did I spend that? We got to go back to work so we can pay off Christmas. And then June rolls around and you're still paying for the turkey, right? And then you start all over again the next year. So I want to encourage everybody out there to start a new tradition with Do Better Financial by joining our Holiday Blueprint Challenge. In 5 days, you're going to design a plan that's going to work for you and your family so that you can defeat holiday hangover. The challenge is going to start on the 13th of November, so not next Monday because that's my birthday and I won't be here, but the Monday after, okay? And you're going to have access to all the tools that you need to create a plan that's going to help you stop that cycle, right? We don't want to get to July, be like, oh, I finally finished paying off Christmas, and then 2 or 3 months later, get right back into it. We want to break that cycle by building a plan that's going to actually work for your family that you can stick to, right? It's about being dynamic. Everybody's Christmas isn't going to look the same. My sister has over 30 people on her Christmas list. That may not be your story. I probably have about 15. That may be closer to your story. You may have no one on your Christmas list, but you typically throw a huge party and it always goes overboard. Whatever you need in your plan is what we're going to try to supply for you. So the regular price is $27, but in honor of our amazing Houston Astros win last night in Game 5 with 13 runs over the LA Dodgers, if you sign up by November 3rd, which is Friday, you can join for only $13, and you're going to walk away with a plan that is ready to go for Thanksgiving, Christmas, and New Year's. We're not going to leave any holiday out. Hanukkah, Kwanzaa, whatever you celebrate, or however you want to deal with it, you're going to walk away with a plan that hopefully will allow you to leave the holidays with money in your pocket, right? That would be amazing. So if you want to sign up, you can go and check it out. There's a Facebook event that I just created. Hi, Sam. Thanks for joining us today. It's called the Holiday Blueprint Challenge. It's on our Do Better Financial page. You can join it there. You can purchase it also on the, in the ticket box, there's going to be just a PayPal link. And right now that PayPal link allows you to pay $13 to join up. Be sure to let me know when you join. I should get your email, but if for some reason I don't get your email and you don't get your kit by next Friday, please feel free to comment on the event page or shoot me a note. I want to thank you so much for joining me today. As I said earlier, my birthday is on Monday, so y'all won't see me next week on Monday, but the challenge will still be going on. You can still get in touch with me if you're ready to get your finances back in order at Christian@dobetterfinancial.com, or you can just get on my website, dobetterfinancial.com, and request a consultation. Thank you so much for joining me this evening, and I will see you maybe next week, but definitely not on my birthday. Thanks, Lucretia. Have a good evening. Bye-bye.